Hi, my name is Jordan Wilson. Today we'll continue our look at mutual funds, this time with what I think are three potential or actual disadvantages, concerns, if you intend to invest in mutual funds. The first potential disadvantage to mutual funds is that you may encounter sales commissions when you go to purchase or possibly sell your investment. A front load would be when you go in and you initially purchase a fund. You will pay a sales commission when you buy, but then later when you sell, there's no fees involved. For example, January 1st, you invest $1,000 in a mutual fund with a net asset value of $50. And that should equate to a 20 unit purchase. But suddenly you have a 5% front load fee. Now you only receive 19 units after paying the load. December 31st rolls around. The NAV of the fund has grown to $55, which equates to a 10% return for the fund. However, because you were only able to invest $950, your return is only 4.5%. You still paid out the $1,000, but with the 19 units, you come out behind. And as we talked about during our look at compound returns, that can be an issue over time. We want as much of our own money as possible to invest and grow on our behalf. Because as we saw with compound returns, it's that income that's earned on previous income that is what grows your wealth. So the more money that you're paying off to a fund company or someone else, that's not growing on your behalf. That's an issue. You might also see back-end loads, also called deferred charges. Here you don't pay when you purchase the fund. But when you do sell the fund in the future, that's when you'll get hit with the charge. The advantage here is that on January 1st, your $1,000 gets you all 20 units. But if you go to sell at the end of the year, suddenly you're paying 5% on $55 net asset value instead of the original 50. And that's good and bad, because you're investing in a fund hoping that it will appreciate over time. But the more it appreciates, the more that you're going to end up paying in deferred fees. The other thing to factor in, though, is that the longer that you defer, the time value of money and the compounding that's working for you may offset that higher cost down the road. But that is a consideration that you're going to have to pay on the back end. The other thing you might see is the declining load. And that's where the commission declines over a period of time. In my example here, maybe if you sell the fund within 3 years, you have to pay the 5% backload. But if you hold out to years 4 through 7, it's only 3%. And thereafter, it's 0. So again, the longer that you wait, the better the deal it is for you. However, as we'll see when we look at management expense ratios and operating costs, there's a reason, and it's not altruistic, as to why fund companies agree to let you pay less fee when you sell the longer you hold. And that's because they're making money each year off the management fees. So the longer that you're invested, regardless of whether you're paying a load or not, you're contributing to paying for their operating costs, you're paying for their management fees. So sometimes holding it longer may not be the wisest move. And a lot of times what you see with sales commissions, especially the front loads, is that it's a trade-off between paying for financial advice and getting it for quote unquote free. If you deal with someone like myself, you're paying an hourly or a flat fee for an engagement, in which case you get completely objective advice, but you're paying a fee up front, and that's coming out of your investing capital. And for many young investors, they don't have that money up front to pay me a fee. So it's often maybe beneficial for them to invest, say, with a back-end load or a declining load, where they don't have to spend money out of their own pockets on day one. They can hopefully hold off for 10 years when they've got more disposable income, and then that back-end load won't kill them. The problem with free advice and deferred or even front-load fees is that over time, what we find is that you probably end up paying a lot more. And again, if you don't have the money on day one, that's a consideration that may be worth taking. But don't be fooled by low or free advice, because over time, that will get quite costly. And we'll look at that in a future episode, just sort of a comparison of how ongoing fees or loads impact your cumulative growth. Another thing you might see are the no fees. So the first one is NoLoad Funds. All your money invests on your behalf. And that's exactly what we want. We don't want to be paying sales commissions. However, sometimes it's not that cut and dried. You have to watch the management expense ratios, the costs of the fund, because there's a reason that it might be no load as opposed to load. Someone still has to get paid. Your advisor still has to get paid. The bank employee still has to get paid. So most of the time, if not all of the time, you're going to see the costs embedded within the ongoing annual expenses of the fund. So you're paying whether you pay the load or you're not. It's just in a different form. Another type of no fee is the no transaction fee funds. It used to be that if I wanted to buy a Fidelity fund, I'd have to set up an account with Fidelity or Vanguard or whomever. But the banks figured out that they'd rather keep their assets within the bank. And so they made an arrangement with some of the fund companies where you can buy and sell mutual funds through your bank brokerage house or online brokerage house. You don't need to set up a separate account per se with the fund company. Now you're still buying and selling directly via the fund company, and there will be some paperwork related to that. But just to keep all the bookkeeping in your one account, banks facilitate this. And because of that, they're not going to say, well, if you set up the account with Fidelity, it'll be free to buy and sell a no-load fund. But if you do the same thing through us, it's going to be $10 or $20 per transaction. So no investor would do that. And as a result, the banks tend to waive the transaction fees on many mutual funds. but there's still some variation between which bank has a relationship with which fund company, so you want to just investigate. And then the question of load or no load. When I analyze investments or make investing recommendations, I take a best of breed approach. So I'll look at the entire universe of investments in a specific asset class or subclass, and based on certain factors, determine what I think is the quote unquote best investment unquote going forward. Now, I factor in the loads, but I seldom, if never, recommend load funds. And yeah, maybe in some of the niches, some of the neglected markets, there could be an argument for using a load fund if there's a lack of alternative investment options. Maybe the load fund has superior performance. But I think in today's world, there's so many no-load mutual funds out there, and they're covering now almost all the niches. So I'm not sure there's an argument anymore to invest in a load fund in a niche. Now that differs a bit, for private equity or venture capital or things like that, but that's a little bit outside, say, the realm of the wider markets for mutual funds. And the other thing you're going to find is that there really isn't a correlation between paying a load and the performance. In fact, one can make the argument that the lower the cost of the structure, the better the performance on a relative basis. So again, I'm not too sure in today's world that you need to look for loads just for specialty markets, or that you will get superior performance because you're paying for it. The only thing I will say is that, as I mentioned at the top of the page, if you're not paying a load, chances are you're paying a fee someplace embedded. So you just need to, again, extract that and figure out what you're really paying for the fund. The final point I'll make is that loads, if you do pay them, are often negotiable. And that could be based on the assets that you're bringing to the investment. If I'm bringing $10 million into a fund, I should be able to negotiate a better load than if I'm bringing 10,000. And that could also work even if I'm buying 100,000 or 50,000 in a fund, but the advisor at the fund company realizes that I have $10 million in other financial institutions. So with the hope of getting that future net new money in their accounts, they may be more generous in cutting you a deal up front. Now here's just an example. RBC, Royal Bank of Canada, Canadian Equity Fund. When I chose it for this example, I didn't even look at its return. I didn't look at its loads. I didn't look at anything. I just chose it because it's one of the larger mutual funds in Canada. It's about $2 billion in assets under instrument. And that tells me that on a relative basis, it's a popular mutual fund. Investors seem to like it, which I hope means that its fees are reasonable and that its performance over time is good. And if we look at it, there's a variety of series or classes of shares, and I think they're all no load now. There was an advisor series that may or may not be shut for new business, but there is a load series as well. But if we look on the top, no load, and I chose 3. There's a Series A, which is no load with a low minimum investment, I think $500. There's a Series D for do-it-yourself investors. And there's a Series F for people that have fee-based accounts with RBC. And then I think there's 3 other series, but we won't get into them. Now, the thing to note here is that they have differing MERs, different management expense ratios. So just because you're buying a fund, you need to investigate and see, where do I fit into the RBC client world? There's a big difference here if I'm considered a no-load, low-minimum Series A investor versus a do-it-yourself investor. So you need to just sort of figure out, and this applies to all mutual funds with all companies, is there's different MERs, so figure out where you slot in before you make that investment. And in this case, with the Series F, it's the lowest, and that's because the clients have fee-based accounts, and that means that they pay a flat fee based on a percentage, say 1% of their assets under management with RBC, and they pay that on an annual basis, and that gets them free services or preferred pricing on other things. In this case, let's say it gives them a 25% discount on this specific fund. So that's the first point. Even for the no load, figure out where you fit in the hierarchy, because you may end up paying a different MER. Now, if we look at the advisor series, it's got a healthy MER, 1.88, and yet they still expect you to pay a load. And they have a variety of options here in this series. You can pay a front load, and that's between 0 to 5% of the amount you buy. And this would be an example of, instead of saying it's 2% or 2.5%, there's some flexibility. There's also a back load, a deferred load, declining load, where if you redeem within 1 year, you pay 6%, 2 years, 5.5%, 3 years, 5%, 4 years, 4.5%, 5 years, 3.5%. After 6 years, nothing. Now, your incentive, obviously, is to wait the 6 years, where you don't have to pay a backload. But each year you're holding that fund, you're contributing almost 2% in fees. So again, you see that correlation between the more generous they are to you on paying a back-end sales commission versus, oh, you've got to hold out and pay a fairly high MER. And this RBC series also seems to have what I'll call a hybrid load. So you pay a front load of between 0 and 2%, much less than the standard front load. And you also pay a deferred load if you redeem within 2 years. So this could be interesting. Maybe I pay 1%, which is cheaper than the front load on its own. But if I hold out for 3 years, that's all I pay. So a little bit of flexibility. That said, if I was dealing with RBC myself and I saw that they had a range of 0 to 5% on the amount of my front load, I tell you, I'd be angling for down near the 0%. I think you'd feel a little bit foolish just as a negotiator, regardless of your asset size, if you ended up paying 4 or 5% when they give you what the range is. If it was me, I'd have probably said, 4%, and then, that used car, I'll talk to my manager and I'll give you a bit of a deal. But that's not the way it's presented here. And I think the other point I want to make now instead of later is, I said that RBC is a pretty large fund for the Canadian market and Canadian investors. So Canadian investors must be relatively happy with it. But when we look at costs, we'll see that the more costs you have in a fund, the more it erodes your performance. We'll also see that the larger a fund gets, the more it becomes the market. And that's especially true in Canada, which is a relatively small equity market. So the RBC fund at $2 billion, how nimble is it? If you consider the small cap stocks, let's say they're 300 million to 2 billion in size. So on the lower end of that, if I'm limited to say 5% investing in a stock, and by 5% I mean 5% of the company's issued capital. So a $15 million or a $300 million capitalized company, even if I invest 5%, I can only take 15 million. If I have a $2 billion stock fund, how much bang for the buck am I going to get, even if I invest in 5% of a small cap with 15 million out of 2 billion? That stock can do incredibly on its own, but it's really a lot of noise in the overall $2 billion fund. It's even worse if you look at micro cap stocks, which are say 50 to 300 million. I could buy an entire $50 million company for my portfolio, but it just gets swallowed up in the rest of the 2 billion. And nano cap stocks under 50 million, same thing. And most of these funds will have, and it changes based on the jurisdiction, but there'll be limitations on what they can actually invest in the amount of a company's outstanding share capital. So again, the bigger a fund gets, the less flexibility it has, and you essentially become the market. And we look at why active managers tend not to outperform their benchmark indexes. That is a large part. The larger you get, the harder it is to find those attractive options. We also see it with this RBC fund in the sense that its 5-year performance showed as 6.3% for the Series A class. Its 10-year performance was 3.6%, and that's the average annual return over that time period. The TSX 300, which is probably a decent benchmark to compare this fund to, over the 5 years, it's done 11.24% versus the 6.3% for this fund. Substantially less return. And over 10 years, the index has performed 5.95% annually versus 3.6% for the fund. So $2 billion heavy for Canadian investors in a fund that actually just underperforms its benchmark. Just interesting. And again, if you look at the delta, the 5.95 over the 10 years for the index versus the 3.6, and then you look at that, the MER is almost 2%. 3.6 plus 2.6 is 5.6. There's another reason, is that it's hard to outperform your benchmark because you have to clear that hurdle rate. And if the benchmark's only doing like 6% a year, and you're charging a fee of 2%, that's a lot of costs to overcome to achieve that outperformance, or as I'll discuss a little bit later, what they call alpha. So again, just an interesting example, and I didn't cherry pick this either. It's just interesting to see this relationship. And if you look at other funds, you'll probably see quite similar results. If we look at the 2020 Investment Company Fact Book, We talked about loads, but what we're seeing is the shift to no loads. And we're seeing a shift from load funds to more of the asset-based fees. We just saw that with the RBC, where people are paying a percentage of their assets under management on an annual basis instead of paying loads. Since 2010, we've seen 1.3 trillion in net outflows of front and back load funds, presumably into no load funds. Backload gross sales have fallen to almost zero. We're also seeing over the 10 years that the percent of long-term mutual fund net assets that were in front and back loads has fallen from 22%, 1/5, to only 12% of all long-term mutual funds. And in that time, we've seen an increase in the no-load fund assets of almost 150%. So the money is coming from the load, the front and the back loads into the no loads. And as a percentage of the total assets in the mutual funds, the no loads have grown from 56 to 72%. So there's definitely, over the last decade, a significant shift in investors moving into no load funds and away from load funds. And I think that's in large part education. They understand the compound return impact. They understand that perhaps they're not getting the outperformance in the loads, so why pay for it? As well as the increased competition that's hit the markets. I said before that it used to be in niche markets, maybe you could only buy a load mutual fund. Today, there's so much competition out there that there's a good chance you'll find a reasonably performing or high performing no load fund. So why pay a load if you don't have to? And the other thing that people are seeing when I talk education is that more and more studies have been done. And what they tend to find is that low-cost funds tend to outperform high-cost funds. And that's on the MER, that's on the operating costs. And they also find that there's no correlation between paying a load and how a fund performs. So again, as investors become more aware of what's out there, then they're moving away from paying fees that they don't need to pay. A second potential disadvantage with mutual funds is in the operating costs, the ongoing costs of running a fund. And you tend to have them broken down into management expense ratio and trading expense ratio, but the terminology differs in different jurisdictions. You might see management expense ratio known as the total expense ratio, but we'll just stick with these definitions. The largest part of the management expense ratio is the management fee. And that's the money paid to the professional asset managers to identify investments, monitor the portfolio, adjust it as necessary, basically manage your money. There's a correlation between the amount of work required in a specific fund and the management fee that's charged. And what you'll find is that different types of mutual funds will have disparate fee structures. For example, if I run an actively managed fund where I'm picking and choosing stocks, that's going to require more work and a higher cost than if I just have a passive index fund where all I have to do is replicate the benchmark. if my fund invests in niche markets or inefficient markets where there's a lack of public information or trading liquidity, that's going to require more work for the managers. You'd expect a higher management fee. If I have a fund that requires complex trading strategies, that's going to require more work than simple strategies. So when you're comparing investments in mutual funds, you want to be on an apples to apples basis. And usually most funds are slotted into asset categories and subcategories or subclasses, so you can better compare peers against each other. Now, if we look at, say, a management fee between two funds, they both invest in African equities. Now, one fund has a MER of 2.1%, the other 2.0. You'd kind of expect that because the funds are, let's say they're similar size, they're investing in the same asset classes, equities, the same region, Africa. So you'd start out thinking, okay, these guys should have a similar management fee. And if they don't, you'd want to investigate what's the value, if any, in the one that's higher cost. Now, if you compare those two African equity funds against a fund that just invests in US large cap stocks, the US equity market probably has better available research. The markets are more efficient as far as trading, as far as insider trading, as far as the flow of public information. So I would think just from the get-go that it's less costly to manage a fund that invests in US large cap stocks than African companies. So I would kind of say, okay, my management fees should be less for the US fund than the African. Another thing you're going to see is that there's economies of scale in costs. If I have a $10 billion fund and I try comparing that to a $100 million fund, now, first of all, I would expect the $10 billion fund to have higher costs, more staff, more paperwork for filings, more shareholder communications, these sort of things, than the $100 million company, which presumably has less unit holders. But what happens is the larger company has more shareholders. So you're dividing your costs over more and more people. That means if I'm an individual investor, I might pay, in fact, I probably will pay less for my share of that $10 billion workload than the $100 million fund. So you need to compare like sizes. And also, that's a problem for smaller funds because you're going to tend to see on a MER basis relatively higher fees for them. If we look at administrative costs, very similar to what I was just talking about, the economies of scale. Now, administrative costs in a fund, that's the back office costs, the costs of running the fund itself, not picking the investments. That sort of includes legal fees, accounting, record keeping, regulatory filings, shareholder communications, staff salaries, office rent, all these sort of things. So you can sort of see why a $10 billion fund will probably have a much higher absolute cost than a $100 million fund. But again, if we spread that 10 billion over a million shareholders versus the other one where you're only spreading their costs over 100,000, you may find that economies of scale make it cheaper for the larger company. And that's sort of one of the secrets to Vanguard or Fidelity or iShares. Their sheer magnitude of their funds and their operations allows them to spread the costs a lot more thinly, and it results in very low cost to their investors on a investor by investor basis. Marketing costs. If you're watching golf or hockey or football, you've probably seen a mutual fund tell you why you should be investing in it. Now, it may seem a little strange to pay an annual fee to market a product that you already own, but I think the thought process tends to be that marketing a fund will attract new investors with new capital, and as the asset base grows, that's a bigger and bigger economy of scale, and that'll result in net savings to the existing shareholders as the pie gets spread over more and more. The point I'd make here is, I think in this day and age, RBC would be a bad example, but I'm not sure that marketing is overly effective. So I may watch golf and see somebody advertising a fund, and I might say, oh, that's an interesting fund. I'll check it out. And then I go check it out, and I'm interested in its performance against its peers. And tied to that is its management expense ratio. So the more money that this company spends on marketing, the higher the MER, the more negative impact on its long-term performance, the less interested I am in the fund. So I think investors these days are often, at least the objective ones, are often fixated on performance. And with so many screening systems out there like Morningstar has, Yahoo, Google, you can just sort of, okay, what's the best stock? And you're not really factoring it in. So I'm not sure there's much benefit in heavy marketing. And then the final item on that is the trading expense ratio, the transaction costs. And that's just, what are the costs in buying or selling investments in a portfolio? And again, the more complex my strategies, or the less liquid the niche markets are, or the neglected markets are, that might impact my transaction costs. So again, the more complex, the more niche, the more neglected, you might see some impact on the transaction costs. But again, the transaction costs, like marketing and administrative, are going to be relatively small versus the management fees of the asset managers. What we've seen over time is a lowering of the expense ratios. And if I look at on an asset weighted basis, and by asset weighted, that's kind of, okay, this fund, RBC, has 2 billion, and this other fund only has 1 billion. So RBC has 2/3 the weight in its MER calculation. If we look at the equities, we see that in 2000, the average asset weighted expense ratio was about 0.99%. And over 20 years, it's fallen by half to 0.52. Similar with bonds, they've gone from 0.76% to 0.48. If we look at it on a simple weighted basis, where you just treat everyone the same, add them up, divide by the number in the population, we see equities are 1.6% on average in 2000, and now they're down to 1.24. And what we see here is that this is kind of an initial thing. The lower cost MERs are attracting more investor capital, because people are shying away from the simple weighted that are up at the 1.6, and they're going down, or I should say the 1.24, and going down to the 0.52 and below. So because it's asset weighted, you're seeing more investors investing in the lower cost MER products. If we dig a little deeper into the investment company fact book, we see more evidence that there's that shift to lower cost mutual funds, low management expense ratio funds, and into the actual passively managed index funds, which are very low MERs. What we see here in this first box is that 80% of equity funds reside in the lowest quartile MER. And that means that 80% of equity funds, the assets, so the investor capital, is allocated to funds in the bottom 25% of cost. So investors are saying, we want low cost assets. If we flip that over, only 20% of investor capital is in that other 75% of expense ratios. So the overwhelming shift today is for people seeking out low-cost funds. We see that the same is true with index equity funds. 83% of investors in index funds are actively seeking out the lowest cost. If we look at the simple MER, we saw that that was 1.24% for equity funds. If we compare them with index funds, it's 0.49. So much cheaper going into index funds. Similar on a weighted average basis. The MER of all equity funds is 0.52, only 0.18 for the index funds. Now the question that comes up is, why index funds? Is there no alpha in actively managed funds? And we saw that a bit with RBC example. If I'm a active asset manager, I'm probably charging significantly more in fees than if I'm just sitting there replicating a benchmark. And by replication, all I'm doing is either buying, if it's say the S&P 500, I'm buying the roughly 500 stocks in the index, or I'm sampling and creating a portfolio out of, let's say, 75 or 100 stocks whose own performance exactly mirrors the entire S&P 500, or I'm using derivatives to synthetically replicate the index. But there's not a lot of work. You just set up the replication and you're done. And then you modify as stocks are added or deleted to the benchmark. I'm not out there going, you know, there's 50 to 100 stocks on this benchmark that are just garbage. I'm not going to invest in them. And there's 50 to 100 stocks on this benchmark that are fantastic. So I'm not going to invest in the dogs. I'm going to take that money and I'm going to invest that in the best. So I should be able to outperform my benchmark quite easily by avoiding the crap and sticking with the good stuff. Yet what we're seeing in investor behavior is that they're moving into index funds. They're moving into low-cost funds. And low-cost funds tell us that we're not spending money on the asset management. And by extension then, these managers must not be doing a great job of outperforming their market benchmarks. And if we look back at the RBC, where the example was that over 10 years, the fund for the Series A was performing 3.6% annually, whereas the general TSX composite was doing 5.95% annually. So when you're presented with data like that, why not just buy the benchmark? So that's kind of gets into the active versus passive debate, and we will look at that in some detail in the next few weeks. The other point I just kind of make here in passing, because we'll look at exchange traded funds in a couple of sessions from now, but what you also find is that ETF index funds are often less expensive in their management expense ratios than mutual funds. And there's a few reasons for that. Although I have to say that over the passing of time, the mutual funds have tightened up their pencils because they're losing business to the ETF index funds. And so that delta, that gap in costs, has reduced. Now, all that said, on the previous slide, I mentioned that when we looked at advantages for mutual funds, one of the advantages was that economies of scale, that aggregation, that pooling of your resources with thousands of other smaller investors so that you get better bang for the buck. And that's true. And it's still true. And again, if you look at even all the weighted average MERs at 0.52, I'm not sure a typical investor on his or her own investing in individual assets can get their costs down to that level. And especially because on an individual basis, the investor has negative economies of scale. So even though I'm talking negatively about the cost structure for mutual funds, it's still cost effective given your alternative of doing it alone. And if you look at the index funds, where you can get down at the 0.18 range, then that's definitely cost effective. To me, it's a disadvantage in the sense that things can always be cheaper, and maybe we'll look at alternative investments that are cheaper. But again, for your typical investor, paying 1.18 for a index fund or even 0.52 for an actively managed mutual fund is pretty good. Another point I just want to make on mutual funds expenses, and this goes to what I was talking about on the previous slide, of how the more complexity, the greater the amount of work required, will usually equate to the more cost involved in a fund. Now, we had here on the weighted average MER for all equity funds, 0.52%. But if we look, the blended US blended stocks, so a lot of, say, S&P 500 type stocks, 0.31. Again, on a continuum or a spectrum basis, there's so much information for relatively large cap US based equity funds. That puts them even lower than the 0.52 average. When we get out to the world, we see it's 0.64, and that reflects the need for doing more work as you get into less efficient markets and trading issues and these sort of things. So your cost of finding assets. You could also make an argument that because the global universe is so much wider geographically and company-wise, that your potential investments are also bigger, which requires more work. And then I've also listed here 0.70 for sector MERs. And again, maybe as we get into some of the sectors, you see that they are less efficient or there's less information. And that will be sort of an average more work, because some of the larger sectors, like maybe consumer staples or materials, will still be quite heavy with large cap US companies. It's only maybe when you get into a smaller sector like precious metals or something that you may have less information. But on average, you see that when you define down to the sector, it requires more work, more cost. And to roughly the same extent true with equity index funds. If it's in a well-established capital market, it's pretty easy to replicate a benchmark. But when you get out to the world, maybe it's not as easy to recreate a specific country or region's benchmark. And same with sector. Maybe some of them are quite small, and again, you get liquidity issues, things like that. So there is a correlation usually between complexity and the cost on the ongoing basis. And the third potential disadvantage of mutual funds, at least to me, is they're not exchange traded funds. And I say that more from a Western Canadian perspective. Canada historically has some of the world's highest management expense ratios on its mutual funds. And that is due to sort of a historic lack of competition in the market, maybe a laziness, maybe lack of investor opportunities elsewhere, maybe a bit of investor education issues. But if we go back to our RBC example, just to pull that one up, again, $2 billion in a Canadian equity fund, quite large for a Canadian mutual fund. Its 5-year performance was 6.3%. Its 10-year 3.6%. The TSX composite over 5 years did 11.24, and over 10 years 5.95. And part of the issue was that when we looked at the management expense ratios, if you were a small Series A investor, 1.89% per annum. If you were a do-it-yourselfer, much cheaper, but still 1.05. And if you got a deal because you had your assets with RBC and were under a percentage-based account, you paid 0.77. If I look at iShares, which them and Vanguard in Canada came in heavy not that long ago, but as bog standard TSX composite ETF from iShares, over 5 years, it was producing 9.52% per annum versus the benchmark of 11.24 and RBC's 6.3. Over 10 years, iShares was averaging 5.53% versus the benchmark of 5.95 and RBC's 3.6. So a lot of that has more to do with the relatively high expense ratios. And when we look at the iShares ETF expense ratio on that fund, 0.06. So even if I'm getting the deal at 0.77, that's still almost 3/4% that I have to make up if I'm the RBC fund. And if I'm the smaller investor at 1.89, that's almost 2 full percent that I'm paying extra. 1.89 minus 0.06, 1.83% to be precise. So combined with in Western Canada and the Canadian mutual fund experience, there is a significant gap in expense ratios. Now, if the mutual funds, in this case RBC, were able to outperform their benchmarks in excess of that difference, great. But as we see over the last 5 and 10 years, that has not been the case. So it's hard when you screen investments to say that a mutual fund is a preferential pick. But as we see more price pressure on fees, and we see this in the United States, then suddenly mutual funds become a more viable option for investors in Canada in this case. So we will look at ETFs, but I've got a few more things that I want to go through with on mutual funds because, again, mutual funds are a useful investment tool if you find the right pricing. And so I want to look at some performance, some diversification concepts and things like that. And a lot of that will be equally applicable to ETFs because they're essentially the same vehicle. Just one trades on a stock exchange, one trades directly with the fund managers, fund companies. And the ETFs tend to be more passive index funds, whereas the mutual funds tend to be more actively managed. So then we'll also get into the active versus passive debate. Okay, that's a lot for today, but I think there were some interesting tidbits in there, especially on how the fees differ between different segments, how you may have different MERs depending on the investor class that you're in, how loads may not bring value. So a lot in there I think that's interesting and a lot that's sort of equally applicable as we move forward into concepts like active versus passive management. Thank you for your time today. Have yourself a good one.